Hi and welcome to this video. We will be talking about the stock investing. Let's begin with the 7 golden rules of investment. If you are a young investor, it is our goal to make you a master investor. Many of the lessons you will learn have been used for successful investors over several generations. You will notice that a recipe for success is easy to follow, but is actually followed by a few. Let's start with a question. Are you an spender or an investor? A pop quiz. Ready? Let's go. The question number 1. I'll give you $100 today or a new Mercedes next year. Which one will you take? Option A, the cash. Option B, the car. Option C, why are you even looking at the other options? You'll be crazy not to take the car. The question number 2. I'll give you $100 today or $100 next year. Which one will you take? Think about it. Option A, the cash today. Option B, the same cash tomorrow. Option C, of course you wouldn't wait. What's the point? You won't get anything in return for waiting. In 1 minute, we will narrow it down whether you are an investor or a spender. You are a spender if you don't get a return. You are an investor if the future is worth somewhere between $100 and a new car. The question of whether if you are an investor is really just a question of how much you believe tomorrow can offer. How much will the future be worth for a bit of sacrifice today? That is a key question that every investor asks themselves. Let's have a couple of questions to consider. Number 1. How much cash would you be willing to give up today in return for a promise to receive $500 5 years from now from that investment? 50, 100, 300 maybe, 450? Number 2. What does a low number, for example $50, say about you? What does a high number, say about $450, say about you? Who are investors? The truth is that we are all investors. When we hear the word investor, we may think of a high-flying Wall Street banker in a blue pink striped suit. That is certainly one type of investors, but so is the business owner, the family trying to save for their kids' college, and the college student trying to scrape up enough quarters to eat dinner. We all need to manage the money we make, and we all hope to end up with as much money as possible. The question of building wealth in your life will be really boiled down in 2 questions. Number 1, are you able to save each year? Number 2, when you save, where do you put the money? This is just hypothetical. Let's assume you are 20 years old and you took a job as a fireman, your childhood dream. What kid doesn't want to be a fireman, right? Your salary is meager, but you make the goal to save $1,000 per year and put it in a retirement account. You work and save for the next 50 years until you retire. Does it really matter where I put the money? I mean, it's only $1,000 a year, right? Well, you have a couple of options. Let's evaluate. Number 1, the saving account, otherwise known as the under the mattress approach. The easiest and safest thing if you could put the money in cash. Nice and safe. It will never go away and it won't go up or down. Your average annual return will be 0%. Amount accumulated in 50 years is $50,000. Number 2, bonds or real estate. Most people say that they get most of their retirement funds from investing in their home and watching it increase in value, or investing in bonds. Both of these options will grow in line with inflation, which on average is about 3% per year. The average annual return will be 3%. Amount accumulated in 50 years is $160,000. Option number 3, the stock market. That's scary, right? It goes up and down. There are times when it can decline by 20% in a short period of time, inducing panic and scary headlines. But over time, the stock market grows with how fast corporation grows. In every 10 years period, the stock market earns about 8 and 10% of return. In fact, over the last century, the S&P 500, the largest 500 companies in the US, have returns 9.8% per year. That will be an average annual return of 9.8%. The amount accumulated in 50 years will be $1,359,199. So does it really matter where you put your money? Oh yeah, it makes all the difference in the world. In fact, the more money that you can put in the stock market early, the more the magnifying effect of a compound interest or component can work in your favor. Albert Einstein said, "Compound interest is the eighth wonder of the world." Now, I know you are thinking, if going from 3% to 10% returns gets me an extra $1 million, what does getting a 20% return do? Warren Buffett, the legendary investor, for example, earned 30% return over a period of 30 years. Call it the famous 30-30. Number 4, beating the market. It isn't easy. It isn't for everyone. But let's say you take a few hours per week and you do your homework and invest in some exceptional companies through the stock market and earn an extraordinary 20% return per year. This is a very high return. Even 12% per year is quite a feat. But let's just assume you're really good at finding great stocks. Your average annual return will be 20%. The amount accumulated in 50 years will be $109,826,190. Yes, that's over $100 million. That's a huge fortune for a fireman just saving $1,000 per year. So now you know why you heard your dad's friends bragging that he beat the market on his investment portfolio last year. The difference between 3% and 10% may seem small, but it makes all the difference in the world towards building wealth. About starting early. Compound interest is a powerful effect, and the earlier you start investing, the more it will work for you. Consider the example of the fireman. But instead of starting to save at 20 years old, instead he started to save at 40 years old. Instead of retiring with $1.3 million, he will retire with only $190,000. Look at the results below, assuming he invests in the stock market. Start saving $1,000 per year at age 40, he will get $190,773 at age 70. If he started at age of 30, he will get $555,682 at age of 70. If he started at age of 20, he will get $1,359,199 at the age of 70. And then, let's say you join Young Investor Society and start investing when you're 15 years old. What does an extra 5 years get you? At the age of 15, you'll get $2,224,948 at the age of 70. Notice that difference is almost $1 million different if you start just 5 years early. In summary, the two critical factors of compound interest are: number 5, earn a high return, for example, the stock market, and 6, start early. And remember, we're all investors, whether you like it or not. What does it really mean to invest in the stock market? Question number 1, what is stock? And what is stock market? You should know that investing in the stock market is a serious business. At the same time, it can be a fun game. Never forget that when you buy shares in a company, you become one of its owners. A couple of questions to consider. What does it mean to buy a stock? And why does the stock market goes up and down? All companies have owners. A small company started with a single individual may have only him or her as a single owner. The large corporations that have stock, which means that shares that are traded by the general public, have many owners. To simplify and organize the buying and selling of these shares by the general public, companies use the stock market. In fact, the U.S. government regulations requires that a company, once it reaches a certain number of owners, must go public. This is to allow its now large number of owners to be able to buy and sell their share of stock in the company more easily. Just think about it this way. Let's pretend that your sibling or a close friend is starting a small company. He or she is doing really well, but needs more capital or more money to expand. He or she asks you to become a part owner in the business by investing some of your savings. You agree. Will you try to sell your ownership in the company just a few days later? Most likely not. It should be the same thing when you decide to buy a public company stock. The only real difference is that your siblings or friends' company is a private company with just 2 shareholders, whereas there are many or more owners in a public company with shares in the stock market. Benjamin Graham said, "Without a saving faith in the future, no one will ever invest at all." To be an investor, you must be a believer in a better tomorrow. Thanks for watching. We hope you learn with our content. We will continue in next videos.